Welcome to MindMirror Audiobook, where we dive into the stories that have shaped our world and offer valuable lessons from the journeys of remarkable individuals. Today, we're bringing you two captivating tales of vision, risk, and resilience. First, we'll explore the rise and fall of Lehman Brothers, a story that illustrates the dangers of unchecked ambition and the harsh reality of financial markets. Then, we'll take you through the inspiring journey of Jeff Bezos and Amazon, where we'll discover how a visionary entrepreneur turned a small online bookstore into one of the world's largest companies. Stay tuned as we uncover the lessons hidden within these powerful stories. Before we dive into today's stories, let's take a moment to reflect on one of the most pivotal moments in financial history, the fall of Lehman Brothers. Once a titan of Wall Street, let's explore how this iconic institution went from success to failure and the lessons we can learn from it. Let's dive into the gripping rise and fall of one of Wall Street's most prestigious names, Lehman Brothers. Founded in 1850, Lehman Brothers started as a humble dry goods store and, over the course of a century and a half, transformed into one of the largest and most respected investment banks in the world. Their reputation was built on a solid foundation of investment banking, asset management, and real estate dealings. The firm was a titan of the financial world, handling billions of dollars, making deals across industries, and shaping the global economy. However, despite its stature, Lehman Brothers found itself caught in a dangerous game during the early 2000s. The housing market, which had been booming for years, seemed like a safe bet. Like many other financial institutions, Lehman decided to heavily invest in mortgage-backed securities, MBS, complicated financial products derived from subprime mortgages. These were loans made to borrowers with poor credit, and Lehman, sensing an opportunity for big returns, dived in headfirst. As the housing market continued to rise, Lehman's investments flourished at first. Mortgage-backed securities were profitable as long as home prices kept climbing. But, despite early warning signs about the risks of subprime mortgages, Lehman chose to ignore them, believing that the market would keep growing. The firm continued to buy and sell these securities, further entrenching itself in a dangerous and unsustainable position. Then, in 2007, the housing bubble burst. Lehman Brothers, heavily invested in these high-risk mortgage-backed securities, suddenly found itself with massive amounts of bad debt. As home prices plummeted and more homeowners began defaulting on their mortgages, the securities Lehman had been relying on became worthless. The company's once thriving investment began to unravel, and by 2008, it was struggling to stay afloat. The firm had too much leverage, borrowing massive amounts of money to fund its investments. For every dollar of equity, Lehman had borrowed several more. This strategy worked well during the boom, but when the market turned, it left Lehman with no cushion to absorb the losses. Their bets on the housing market, combined with high leverage, made Lehman vulnerable to collapse. Lehman's executives, however, didn't adjust their strategy when the storm clouds started gathering. They stuck to their guns, believing the housing market would bounce back. This overconfidence and refusal to pivot proved to be their downfall. While other institutions started hedging against the risks of mortgage-backed securities, Lehman doubled down, continuing to invest heavily in these assets. In the months leading up to their bankruptcy, Lehman desperately tried to find a buyer or secure a bailout. They negotiated with potential buyers, such as Barclays and Bank of America. But ultimately, no deal came through. Unlike other failing institutions, like Bear Stearns, which received emergency bailouts, Lehman did not get government assistance. The decision by the Federal Reserve and the U.S. Treasury Department not to intervene is now seen as one of the most critical moments that led to Lehman's downfall. And on September 15, 2008, after failing to secure a buyer or a government bailout, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in U.S. history at the time, and the shockwaves reverberated throughout the global financial system. Panic spread as Lehman's collapse eroded trust in the entire financial system. The markets went into free fall, and the world was thrust into one of the most significant financial crises of modern history. So, what led to this catastrophic failure? Overexposure to the housing market. Lehman's decision to pile into subprime mortgages and mortgage-backed securities was a critical error. They accumulated massive amounts of risky debt, all the while ignoring the mounting risks as the housing market began to show cracks. When the bubble burst, their overexposure to this sector became their fatal flaw. Excessive leverage. Lehman was borrowing heavily to fund its investments, amplifying its risk. When the market began to crash, their massive debts and lack of a financial buffer made it nearly impossible for the firm to stay solvent. The firm's high leverage made the crisis far worse, turning a manageable loss into an insolvency crisis. Failure to adapt. While other financial institutions started to reduce their exposure to risky mortgage-backed assets, Lehman continued to bet on the housing market's recovery. Their executives refused to adjust their strategies, ignoring clear warning signs. This failure to pivot was crucial in their collapse. Lack of government support. When things went south, Lehman had no safety net. Unlike Bear Stearns, which had been bailed out by the U.S. government, Lehman received no such help. The refusal of the Federal Reserve and the U.S. Treasury Department to intervene left Lehman with no other option but to file for bankruptcy. And investors and financial institutions quickly lost confidence. Credit dried up, and Lehman couldn't access the liquidity it needed to stay afloat. Financial institutions worldwide were exposed to Lehman's bad debt, and they too began to face massive losses. The market crash that followed was swift and severe. Stock markets plummeted, banks became reluctant to lend, and the global economy entered the worst recession in decades. The financial system was paralyzed, and millions lost their jobs, homes, and savings. The U.S. government's response to Lehman's collapse was swift. In an effort to stabilize the financial system, the government bailed out other institutions, such as AIG and Bear Stearns. Lehman Brothers' story offers several crucial lessons in risk management and financial strategy. The dangers of overleveraging. Lehman's use of excessive leverage to amplify returns in a booming market ultimately became its downfall when the market turned. Lehman failed to adequately manage the risk associated with its exposure to subprime mortgages. Effective risk management requires diversification, hedging, market euphoria, and the danger of following the herd. During the housing boom, market optimism blinded many financial institutions to the risks of subprime mortgages. Lehman, like many others, ignored the underlying dangers and continued to invest heavily in the market. This story reminds us to question market trends and do our own due diligence. Conclusion. The rise and fall of Lehman Brothers offers a critical lesson about the dangers of excessive risk-taking, poor risk management, and the importance of financial transparency. Lehman's story serves as a cautionary tale for investors and financial institutions, emphasizing the need to balance risk with caution, diversify investments, and be willing to adapt to changing market conditions. In the wake of Lehman's failure, the financial industry was forced to reconsider its strategies and rebuild. But the lessons of this collapse remain as relevant as ever. As we reflect on the collapse of Lehman Brothers, a story of financial hubris and the catastrophic consequences of unchecked risk, we are reminded of how fragile the global financial system can be. But in the world of business, not all stories end in disaster. Sometimes, the lessons learned from one failure can lead to extraordinary success in the future. This brings us to the story of Jeff Bezos and Amazon, another tale where vision, determination, and an unwavering belief in the future made all the difference. Unlike Lehman Brothers, Bezos took a different path, one that required immense patience and a commitment to long-term growth and customer service. Let's now turn our attention to the story of how one man's bold vision led to the rise of Amazon, an empire that would not only survive, but thrive in an ever-evolving digital age. Let's take a journey back to 1994, when a man named Jeff Bezos set out to change the world. At the time, The internet was still a nascent technology. While many people were skeptical about the future of online shopping, Bezos believed the internet was destined to become the new shopping mall. And so, with this belief, Amazon was born, not as the giant we know today, but as a small, humble online bookstore. In the early days, Amazon wasn't focused on profits. Bezos had a long-term vision, one that required massive reinvestment. He didn't just want Amazon to be an online bookstore. He wanted it to be the everything store, a place where customers could buy anything and everything, including skepticism from investors and fierce competition from established brick-and-mortar retailers like Barnes & Noble and Walmart. Despite the challenges, Bezos stuck to his vision. For the first 7 years, Amazon operated at a loss. Every cent of revenue that came and went right back into the business, whether it was used to hire employees, develop technology, or expand the product catalog. Critics often questioned Bezos' decision to prioritize long-term growth over short-term profits, but he was steadfast. He knew that by reinvesting and building the infrastructure for a global company, he was setting Amazon up for something far bigger than immediate financial returns. The early struggles and challenges. One of the biggest challenges Bezos faced in the early years was convincing investors and the public that e-commerce was a viable model. In a world dominated by traditional retail, buying books online, and later, everything else seemed like a risky and speculative endeavor. The idea of trusting a website with your credit card information to purchase items wasn't something people were comfortable with at first. Amazon faced significant competition from well-established retailers who had physical stores, vast resources, and loyal customer bases. But Bezos didn't just rest on Amazon's status as an online bookstore. He constantly innovated and adapted. He understood that for Amazon to succeed, it couldn't just be a niche online retailer. It had to be a platform that delivered unmatched convenience, selection, and customer service. Another critical obstacle was scalability. As Amazon expanded its product offerings, it needed an infrastructure capable of handling massive amounts of orders and inventory. Unlike physical stores that could rely on existing distribution networks, Amazon had to build everything from scratch. This meant investing heavily in warehouses, logistics, and technology, while others relied on established systems. Bezos bet on building Amazon's own fulfillment network, ensuring speed, efficiency, and cost control. It was a huge gamble, but Bezos understood that the logistics of delivery and fulfillment would be critical to Amazon's future. The actions that built Amazon. So, what made Bezos' vision work? It wasn't just about selling books online. It was about long-term vision and relentless reinvestment. Bezos made it clear from the beginning that Amazon wasn't interested in short-term profits. Instead, it was focused on building a scalable platform for the future. Every investment made was aimed at expanding product offerings, developing technology, including the game-changing Amazon Web Services, and refining the logistics network. At the core of Amazon's early success was Bezos' customer-first philosophy. From offering free shipping to ensuring easy returns and creating personalized recommendations, Amazon made shopping easier, faster, and more convenient for customers. Bezos obsessively focused on improving the customer experience, which helped establish Amazon's brand as trustworthy and reliable. Even in the face of early financial losses, Amazon's commitment to customer satisfaction created a strong foundation for future success. Expanding beyond books. Bezos knew that books were only the beginning. While Amazon's initial success as an online bookstore was significant, Bezos understood that for Amazon to become the everything store, it needed to expand its offerings. The company quickly moved beyond books, adding electronics, clothing, home goods, and a variety of other products. This strategy paid off, as it allowed Amazon to reach a much broader audience and tap into new markets, growing exponentially in the process. In 2006, Bezos made another groundbreaking move: the launch of Amazon Web Services, AWS. AWS was a cloud computing service that allowed businesses to host their data and applications on Amazon servers. What seemed like a small side project at the time soon became one of Amazon's most profitable ventures, providing a steady stream of high-margin income. AWS quickly established itself as a leader in the cloud industry, becoming a key asset for Amazon, building infrastructure and dominating logistics. As Amazon grew, Bezos knew that controlling the supply chain would be essential to maintaining competitive advantage. By building its own fulfillment network, Amazon was able to offer faster and more reliable delivery than its competitors. Unlike brick-and-mortar retailers that had to rely on third-party distributors, Amazon controlled its own logistics, ensuring seamless operations and eliminating inefficiencies. This allowed Amazon to scale quickly and meet the demands of a global customer base. By investing heavily in warehouses, logistics management, and technology, Bezos created a highly efficient system that would later serve as the backbone of Amazon's global operations. The speed of delivery became one of Amazon's key differentiators, giving the company a massive edge over its competitors in the e-commerce space. The result: Amazon's global domination. Bezos's long-term strategy ultimately paid off. Today, Amazon is one of the most successful and valuable companies in the world. Its market value has exceeded $1 trillion, driven by its dominance in e-commerce, its market-leading position in cloud computing with AWS, and its expansion into new sectors like streaming, groceries, and artificial intelligence, thanks to its focus on customer satisfaction and convenience. Meanwhile, AWS continues to provide a massive stream of profit. Jeff Bezos' journey with Amazon shows that true success is built on a long-term vision. Amazon's rise wasn't about short-term profits. It was about creating a company that could scale exponentially over time. Bezos' decision to reinvest profits instead of focusing on immediate returns allowed Amazon to dominate the e-commerce and tech markets. Reinvestment as a growth strategy. Amazon's focus on reinvestment into technology, infrastructure, and customer service was key to its growth. Instead of looking for quick profits, Bezos built a company designed for sustainable success. This approach illustrates the importance of investing in long-term growth. Customer-centric approach. Amazon's relentless focus on the customer set it apart from its competitors. Whether through faster delivery, personalized experiences, or easy returns, Bezos' customer-first mentality built a loyal base. The lesson here: customer satisfaction is crucial to long-term success. Diversification and innovation. Bezos' willingness to expand Amazon beyond books into other product categories and later into cloud computing with AWS was pivotal to Amazon's success. Innovation and diversification kept Amazon ahead of the competition and helped it open new revenue streams. Control over the supply chain. By building its own logistics network, Amazon gained full control over its delivery times and costs, a strategic move that allowed the company to scale rapidly. The lesson here is the importance of controlling your supply chain to maintain efficiency and drive competitive advantage. Conclusion. The story of Jeff Bezos and Amazon is a powerful reminder of the value of long-term thinking, reinvestment, and innovation. By focusing on building a sustainable business model and prioritizing customer satisfaction, Bezos turned Amazon into one of the world's most successful companies. For any entrepreneur or investor, Amazon's rise teaches us that patience, strategic expansion, and a relentless focus on the customer can lead to extraordinary success. Thank you for joining us on this insightful journey here at MindMirror Audiobook. We hope these stories of ambition, vision, and resilience have inspired you as much as they've inspired us. Whether it's the rise and fall of Lehman Brothers or the incredible ascent of Jeff Bezos and Amazon, the key takeaway is clear. In life and business, long-term vision, hard work, and strategic risk-taking are essential to success. Don't forget to subscribe for more stories that will ignite your mind and encourage you to reflect on your own journey. Until next time, keep learning, keep growing, and keep reflecting.